And welcome to James Cooper Creston's Budget Seminar 2021. My name's Alex Peel. I'm Joint Managing Partner at James Cooper Creston, and it's a pleasure to be with everybody this morning and welcome you to our seminar. As everybody will have known, there's been a lot of build up to this budget. We've been talking about it probably almost since Rishi delivered his budget last year. A bit of a false start in the autumn when we almost had a budget, but hopefully we'll discover today, to a certain extent at least, has this budget actually lived up to its billing. Now, obviously, just under a year ago, we were all sat at Newbury Racecourse having breakfast together, and sadly, it's not possible to do that this morning, although I think just under 400 people are logged on. I can't see you all, but I think you're all out there. So hopefully you'll all be able to hear and understand and see what's going on this morning. On your screens also, as well as the presentation, you should be able to see a question and answer box, a box that has polls, and we're going to be asking some questions later on of you, and also some other information down the side of your screens where you can click on the links and obviously download further information. And just to confirm, this presentation will be recorded and will be available to attendees and to others after the presentation today. So what are we going to do this morning? It's going to be a bit different from usual. It's already different because we haven't enjoyed our full English together and we're not all sat around at tables. So it is going to be a bit different. I'll shortly introduce you to one of my partners, Alex Nicholson, who's going to provide an overview of the key announcements yesterday, the key things announced in the budget, and perhaps some of those things also announced beforehand and profiled by the press. We're then going to be joined by some other colleagues, so Alex, who you'll already have met, Phil Snell, Ian Miles, Amira Raja, all fellow partners of mine in the firm, and we're going to then look in a bit more detail at certain aspects of the announcements, what it means and what it might mean for some of our clients. Once we've done that, there will be time for us to answer your questions, and as I mentioned earlier, you should have the Q&A function on your screens, so please do ask questions. We'll try and get through as many of those as we can do. I see that we've already got one that's come in. We'll get through as many of those as we can do as well. And of course, if we don't get through them, perhaps afterwards we can be in touch, or you can be in touch with us and we can discuss those matters further as they might affect you. So once the budget's happened, it's always interesting to see how the media react, how the press react. And in previous years, we've often had the headlines up for people to see. I have made an essential visit to the shops this morning to buy a number of newspapers just so I can see the flavour of what's been reported. So it's an interesting mix as usual, I think. The Telegraph leads on Rishi's reveals 5-year tax grab, and then the Independent's got Sunak's 400 billion route out of the COVID crisis. The Times, similarly, highest tax levels for 50 years, business and families to pay for COVID, although it does note sort of additional and where that money is going to come from. The Guardian, spend now, pay later. Sunak flags major tax rises as COVID bill soars. And then we get to the Daily Mail, and you have to look quite hard on the Daily Mail. It's sort of there in pictures at the top of the page, and then they've got their 13-page budget special, but certain royals are the star of the show on the Mail's front page. The Sun, of course, has got their headline, the only way is SUP, prepare yourselves for an almighty hangover. Booze, fuel, furlough boost. And then we get to the Daily Mirror. And if you had to look hard on the Daily Mail's front page, you have to look very, very hard on the Mirror's front page. The Mirror, you have to get all the way through to page 10 to find anything about the budget. And again, of course, they lead with Meghan and Harry. Something I discovered this morning also through a magazine subscription I have on my iPad. I also have access to the Daily Star, and the Daily Star has absolutely no mention of the budget at all. They lead with Mr. Grumpy and Mrs. Shy. So if you're trying to get away from the budget, then perhaps that's where you need to go to this morning. One of the things that we often do in the past at our budget seminars is ask you questions, and as I mentioned earlier, we are going to ask you some questions later on, and in the polls box at the side of your screen you will shortly see the first of those polls launched. I'll explain a bit more about that in a minute, but I thought it would be quite useful to see how we got on last year. I think the budget was on the 11th of March last year, and we all sat together on the 12th of March. So just before we really probably full understood the impact of COVID. So we asked you last year, do you think we're likely to have a full UK-EU trade deal by December? Interestingly, the vast majority of people last March said no. And I guess we can argue as to whether it is a full trade deal or not a full trade deal. But it's interesting to see how many people thought that wasn't achievable last December. And then we asked you some other questions. We asked about how many medals we were going to win at the 2020 Olympics. And if you have got very good eyesight on your screen, you should be able to see that a small number of people said 0 because it will be cancelled. And I guess they were probably right, because whilst it's not been cancelled, it certainly didn't happen in 2020, and perhaps that was something that none of us expected, because none of us expected this to last as long as it has done. And then finally, do you think the 2020 Olympics will happen? And again, more than 50% of people this time last year thought that it would happen at some point in 2020. So it's interesting just when we think back to how we were thinking at that stage last March. So as I mentioned, we're also going to ask you questions this year. You should now see the first question. In only his second budget, do you think that Rishi did a good job? And the way we're going to do this is, if you can answer the questions when you see them come up, we'll collate those answers and then review them all at the end of the presentation. So I'm now going to hand over to Alex Nicholson, who, as I mentioned, is going to give more of an overview of some of the key changes.
Thanks for that, Alex, and good morning, everybody. So yes, really, I'm just going to spend the next 15 minutes or so going through the headlines, the key announcements. So we'll start off with the further coronavirus support measures, and then move on to taxation. So if I could have the next slide, please. So first of all, then, the measures really for protecting jobs and livelihoods, coronavirus support measures. So the job retention scheme, the furlough scheme that we'll all be familiar with now, has been further extended to the end of September this year. So it's been extended by a number of months, and it's going to continue to pay 80% of employees' wages to the extent that they're furloughed, up to a cap of £2,500 a month. One sort of slight change, really, I suppose, is that as the Chancellor wants to sort of unwind that scheme, is that employers are going to be asked to actually make a contribution to the time when employees are furloughed. And that financial contribution is going to be 10% in July, and then rising to 20% in August and September. And then seemingly that will be the end of the scheme unless there's any further announcements down the track. The Chancellor was also quite keen to announce a number of enhancements to the self-employed grants, which, just as a reminder, are taxable grants. So the self-employed or partners in partnerships who receive those do need to record those on their tax returns. So 3 grants have already been paid, so the 4th and 5th grant will be as follows. So basically the 4th grant will cover the period from February till April this year, and it's going to be paid at a rate of 80% of a trader's 3-month average profits, up to a cap of £7,500. And HMRC has the data from past tax returns and is able to calculate the average trading profits for these purposes. The 5th grant then will take us up to September, so it covers the period from May to September, and it introduces an additional test. So basically there's a turnover test, and it says that if your turnover as a result of COVID effectively has decreased by 30% or more, then you can still have 80% of your average trading profits up to a cap of 7,500. However, if your turnover has decreased by less than 30%, you're only going to get 30% of your 3-month average trading profits, and that's going to be subject to a cap of £2,850. So because this is now introducing a measure whereby the government don't have information for it, people who claim that are going to have to make a financial income declaration to say whether their turnover has been affected by more than 30% or not. And the other big sort of headline measure, I suppose, or announcement yesterday was that it's also going to be extended to the more newly self-employed. And that had been a criticism of the previous scheme, was that if you were newly self-employed, you couldn't claim it. So basically what you can now be included if you were self-employed on your 2019-20 tax return, but only if you filed that by midnight on March the 21st. So if you haven't filed your tax return yet for 19-20 and you're self-employed, you won't be entitled to claim this grant. We also saw the national living wage. That's going to be increased from £8.72 per hour to £8.91 per hour, and that applies from April this year. And just as a reminder, that up to April this year, it applies to workers who are aged 25 or over. But from the 1st of April, that's going to come down. So it's going to apply to workers who are 23 and over. The government also announced that people who take on hire apprentices will be able to get a £3,000 payment now per hire, which is a doubling of the previous £1,500 rate. And also, the bounce back loan schemes and the CBILS loan schemes are due to come to an end fairly soon. So the government announced a new recovery loan scheme. And I think this is less generous in the sense that my understanding is it doesn't come with any sort of interest-free period, but it is still government underwriting the borrowing to the tune of 80% on loans between 25,000 and 10 million. Next slide, please. So I guess one of the key announcements really for the retail, hospitality and leisure sectors is around business rates, and the business rate relief has been extended now. The 100% relief is going to carry on from the 1st of April to the 30th of June. And at that point, it's proposed that it will drop to 66% relief, and that will carry on then through all the way to March 2022, i.e. well beyond the end of what the government expects the lockdown measures to sort of last, and therefore continue to provide ongoing support for several months into next year as well. It is going to be capped at £2 million per business if those businesses were closed on the 5th of January 21. Otherwise, it's going to be capped at 105,000 per business. Restart grants were also announced, and this is to help those businesses that have been forced to shut to get going again, basically. And that's going to be up to £18,000 per premises for hospitality, accommodation, leisure, personal care, and also for gyms. And there's a range of measures, I think, which also would include sort of the creative industries, film and TV, theatre, etc. And for non-essential retail, there's going to be a lesser grant, which is going to be up to £6,000 per premises. The Chancellor also announced a new mortgage guarantee scheme, which I think is aimed at allowing first-time buyers to get onto the housing ladder. Basically, it just seems to mean that they can take on very big debts, but they can get on the housing ladder with only a 5% deposit, with the government guaranteeing their mortgage. And apparently, many lenders are already sort of signed up to that, and they're going to start being offered from next month. As many of you will have been aware, because it's been widely reported, I think there's a lot of very stressed out conveyancing solicitors at the moment who have been desperately trying to get house sales through by the end of March in order to take advantage of the SDLT nil rate band extension, whereby currently there's no SDLT on the first £500,000 of a property purchase. That's now been extended to the 30th of June 21, which provides a bit more time, obviously, for all those things that are in the pipeline to complete. But rather than produce a cliff edge at the 30th of June, the Chancellor is then going to say half that amount of relief is going to be available through until the 30th September 21. Next slide, please. So moving on now to tax matters. So I'm going to start with corporation tax. Of course, the big headline is that corporation tax will increase to 25% with effect from April 23, so that's in 2 years' time. However, the Chancellor was very keen to stress that he's going to introduce a small profits rate, which means that businesses who have taxable profits, tax adjusted profits, I should say, of up to £50,000 still only pay the current 19% corporation tax. And actually, it was a surprise to me to learn that he thinks that that encompasses 70% of all companies in the UK. So it's only 30% that will be subject to the increased rates. And we also then see a taper that's coming in for profits of between £50,000 and £250,000. And effectively what that means is that profits which fall within that taper rate are subject to a higher marginal rate of tax of 26.5%. I put on there that it's a sort of reintroduction in the sense that a number of years ago, probably 10 or so years ago now, we used to have a similar scheme, and it's proof really that if you work in tax too long or long enough, then old policies seem to come round and be presented as new ones again. Another quite major announcement, I think, was the extension of the loss carryback rules for companies. Generally, a company can carry back its losses for a 12-month period, but that's going to be extended to 3 years for accounting periods that end between the 1st of April 2020 and the 31st of March 2022. It's also worth noting that that extension of the loss carryback is not only for companies, and it's going to be available to unincorporated businesses too, so the self-employed and partnerships. A certain amount has been made in the press, I think, of this 130% super deduction. And I'm sure I heard Simon Jack on the BBC News last night saying that businesses were going to get £1.30 for every £1 they spend. It's not a sort of cash benefit that gets paid out. It's a cash flow benefit in essence. But there is an uplift. So effectively, where businesses buy qualifying plant and machinery, instead of being able to write off the normal sort of rates for that relief, they can actually claim 130% super deduction against their profits. Certain assets don't go into the plant and machinery main pool, they go into a special rate pool. The most obvious ones of those are things like fixtures and fittings within a building, certain cars and things of that nature. And they're going to qualify for a 50% first year allowance. And that's going to be for expenditure for 2 years with effect from the 1st of April 21. It's worth noting that there's already effectively 100% first year allowance where you claim the annual investment allowance, which it had already been announced was going to be maintained at the current £1 million level through until the end of 2021. So going forward, it's going to be quite interesting, I think, to look at how capital allowances get claimed in order that you can maximise the benefit of the relief. I think we're going to come on to look at some more aspects of this a little bit further on with our sort of Q&A session. Just a quick mention on R&D tax credits. I mean, there were no major announcements on that yesterday, other than the fact that there is going to be a consultation, which is going to, I think, look at whether the scheme could be improved at all. But just a reminder that there is this new R&D tax credit cap that's coming in from April 2021, and that is basically limits. So sorry, this is companies where they have losses and they want to surrender those losses to the revenue because they're R&D losses. They can get a payment, a tax credit back from the revenue. And that's uncapped at the moment, but it's going to become 20k plus 3 times the company's total PAYE and NICS liability for the period. It's worth noting, however, there are a number of fairly valuable sort of exceptions where the new cap won't apply. Also, just to mention around off-payroll workers, just a reminder really that these new rules, which were pushed back in April last year do come into effect from April this year. And basically, you know, what these are aimed at is where you've got individuals who use personal service companies and various other sort of intermediaries. It puts the onus on the engaging company, if you like, or engaging business that's engaging that worker to make a decision as to whether PAYE and NICs need to be applied in respect of payments that are made. So they have to make the decision as to whether to treat them as an employee or not. Also, I mentioned that there's going to be a consultation on enterprise management incentive share options, just hugely popular share scheme, and really, again, around looking at whether it's competitive or could be improved further. If I could have the next slide, please. So moving on then to VAT and duties. The VAT registration threshold is going to be frozen for 2 years at its current level of 85,000. Thereby effectively sucking more businesses into needing to register and charge VAT on their products and services. It's effectively a tax increase. Businesses who opted to defer their VAT payment to this March, if they haven't already paid it, they've now got an option to, instead of having to pay that this month, they can pay it by instalments, interest-free instalments, up to 11 interest-free instalments. And the mechanism for that is going to be via an opt-in through a portal, with the government then taking those payments by direct debit. One of the further sort of COVID support measures for the tourism hospitality sector, of course, has been the 5% reduced rate of VAT. It's been announced that that's going to carry on now until the 30th of September 21, so it's been extended by a number of months. But rather than them being withdrawn entirely, it's going to reduce to 12.5%, and that's going to run through until March 2022 before those businesses are required to charge VAT at 20% again. I think in the main, those savings are being used by those businesses and not being passed on to consumers, and therefore it is a mechanism of providing valuable relief. Just a reminder that Making Tax Digital will extend to all VAT registered businesses. That's including the self-employed and landlords, with effect from April next year. I mention also that the surcharge, the penalty regime effectively for late paid VAT, is going to change from April 2022. Currently, the system doesn't really distinguish between how late you pay your VAT, and therefore this is introducing a sort of tiered system whereby if you're only a few days late, you shouldn't expect to get a penalty. And there's going to be a similar regime that's going to apply for income tax self-assessment, which also currently operates on a similar basis. Good news for many, fuel and alcohol duties have been frozen for a year. And just a brief mention on the end of this slide about free ports and the 8 free ports that were announced, which will include the Solent region. And we're planning on picking up on that in a bit more detail a bit later on. Next slide, please. And so just a quick sort of canter through really personal taxes. No change to the headline rates of income tax, but as has been widely reported, an awful lot of thresholds, current allowances, are going to be frozen for 4 years until April 2026, so-called fiscal drag, which is of course really a tax increase. And that's going to apply to the income tax personal allowance, which is going to be pegged at just over 12,500. The rate at which people pay higher rate income tax is going to be pegged at just over 50,000. So that's the point at which the 40% tax band kicks in. And the same is going to be true then for the national insurance thresholds. When it drops to the lower national insurance rate, that's going to be pegged as well. So you'll be paying more national insurance at a higher rate. The capital gains tax annual allowance remains at 12,300 for the next 4 years. And the overall amount that you can put into your pension in your lifetime is also, which is normally increased by, I think, a CPI or something each year, that too is going to be fixed, therefore limiting the overall amount people can get into their pensions. Also, the IHT nil rate band's frozen as well. I suppose the big one that didn't feature in the end, that had been widely talked about in the press, was changes to capital gains tax rates. Nothing was said about that at all yesterday, which means that the current regime continues to exist, including entrepreneurs relief, or as it's now called, business asset disposal relief. So no changes, and I just put in there whether, yet will we see changes further down the line? Who knows? Next slide, please. And just a few final thoughts from me, really, before I hand back over to Alex. Just to question really whether the election manifesto pledge not to raise income tax, NIC and VAT is intact. Certainly it's there for the headline rates, but obviously the fiscal drag that we've talked about is effectively a tax increase. And the tax changes that have been announced really are going to barely scratch the surface of the deficit that we've got. For example, the corporation tax increase to 25% is forecast to raise an additional 17 billion a year for the Treasury by 25-26, and that compares with our borrowing in the current fiscal year alone of 355 billion. I also thought it was quite interesting one comment the Chancellor made yesterday, which was to note that with the debt, our nation's debt being what it is, a 1% increase in the rate of interest on that borrowing actually has a cost to the country of 25 billion pounds a year. So there really is a lot of sensitivity around that interest rate, and it's manageable whilst it's low. But if interest rates do start to go up or go up further, then it really does add to the cost and indeed the budget deficit potentially. So I think really the Chancellor is hoping that the economy will rebound strongly, and that will do most of the work to reduce the deficit as we hopefully come out of the current situation. So that's it for me for now, and I'll just hand back to Alex.
Thank you very much, Alex, and we'll pick up on some of those points no doubt later on. So thanks to everybody who's answered the first poll question. Quite a few answers coming in there. So the second poll question will shortly appear on your screen. So if you can go in and answer that one as well. It's a fairly simple question, just to sort of sense what people are feeling. What do you think of the measures that Rishi has put in place so far to aid recovery at this stage? And there are 3 options to choose on that one. Okay, so as mentioned, the next part of our webinar seminar this morning will be more of a discussion with some more colleagues about some of the announcements. Hopefully pick up some of the points that are coming in on Q&A so far. But if we don't pick up your particular question, or you do have a question, please do ask. They're starting to come in as well. So I'd like to welcome again, or introduce to the screen, Ian Miles, who's many of you will have known from previous years, who's presented on our budget seminars over the years, and also Phil Snell, who's a business tax partner based in our Reading office. So perhaps, Ian, if we can start with you. There's been a lot of speculation about what's going to come up. The papers seem to have a bit of a mixed reaction this morning to what has happened. From your perspective, I just wondered if you, from a personal perspective, and then we come on to you, Phil, who would you say the winners and losers are from the announcements yesterday?
Well, good morning, everyone. Thanks, Alex. I think there are some winners and some losers, probably more losers than winners. I think obvious winners are house buyers, for whom the SDLT scheme's been extended. So we know that the 500,000 threshold sits with us till the end of June. And then we've got 250,000 till the end of September before it falls back to the 125,000 from the 1st of October onwards. We've got also the mortgage guarantee scheme. Just looking at some of the details, I can remember there are at least 4 major lenders who have signed up to that already. If they make a bad loan, then they share some of the pain with that, but the government guarantees everything, all their losses over 80%, bar the last little 5%. So I think that's good for house buyers. Those whose businesses have suffered COVID losses, so if people have had a drop in profits and they've turned into losses, and that's both from my point of view for sole traders and partnerships, and including LLPs, if they've made a loss in the current tax year or in the next tax year, then that loss of up to £2 million can be carried back. Now, previously it could be carried back for up to 1 year. In this, what he's done now is give more flexibility to enable that loss to be carried back for up to 3 years. Although we were just starting to scratch our heads a bit last night, because you use your losses on a last in, first out basis. So if you had a loss this year, you might use up last year's profits and perhaps some of the years before. By the time you get to a loss in the following year in 2022, you might be restricted on what you can do. Depends on the size of them. The third one, you alluded to what might be coming down the line. Those who thought about or started inheritance tax or CGT planning but didn't finish it. So perhaps they were trying to do a sale of a business or of a particular asset or something like that, and it didn't get past the line before yesterday. Well, the good news for all of those people is they can still continue to do it, and they'll be able to do it after the 6th of April as well. And then finally, as Alex indicated on his slide, for the drinkers and drivers, hopefully not both together, there's no increase in either alcohol duty or in fuel duty. In terms of the losers, I think I can probably lump them all into one class, and that is that all those people who are caught by no increase in rates, thresholds, exemptions and allowances. And the Chancellor was very keen on the telly this morning to point out that it makes no difference to anybody today, because they'll still have their personal allowance. The high rate threshold, it's gone up by CPI this year. But of course, one of the points he wanted to make was he was being very transparent about the pain that was going to come. And we've got very used over the last few years to having chancellors stand up and say, not only can I give you £50,000 as the target before which you pay higher rate tax in this parliament, I can give it to you a year early. Well, this year the boot's been on the other foot, and he's been pretty clear about what is not going to happen until 2026, unless the economy rebounds phenomenally and he says, actually, I can afford to do it. But like Alex Nicholson, I think that these tax cuts, which is effectively what they aren't, will only scratch the surface of paying off the deficit. So for all of those people, I think it will affect people who are doing inheritance tax planning, where estate values increase. It will affect people making capital gains if the stock market and other asset values rebound. It will probably catch people who are close to the pension savings cap, because they may have pension charges. So there'll be a whole group of people who, instead, if they get a pay rise, whereas part of the tax effect of that pay rise will have been eroded by having a higher personal allowance, that won't happen. So it's not inflation proofed at all. They will pay tax on all of their increase in value that they get. So those, I think, are the broad category of people who are caught in the losers category.
Thank you, Ian. And from a business perspective, would you like to comment on that?
Yeah, and Ian picked up obviously on the capital gains tax. I think one of the key winners is those that were in the process of selling their business, that were hoping to be able to qualify from entrepreneurs relief, or as it's now known, business asset disposal relief. Those limits and conditions haven't changed. There's been no mention of that in the budget at all. So they continue to be the lifetime limit of 1 million, the 5% ownership and the 2-year ownership conditions all remain the same. And I think whilst tax should never be the driver behind decisions that you're making, I think certainly for those that were either in the process of thinking about selling or are expecting to sell in the short term, I think it is important that you contemplate accelerating that, because it is an area that you can see being something that might not continue to remain the same in the future. And I think from a more kind of corporate tax perspective, the obvious winners are those smaller companies that can benefit from the 19% rate going forwards. I think there's some detail for those to look at in terms of the impact that it might have, and the fact that I think it will catch more than we might expect. And I think for larger companies, it's a kind of a mixture of a good and bad news. In the short term, there is the good news associated with the super deduction for capital expenditure. That will generate, for those that are looking to spend and importantly are able to spend, and in the short term, that will create a significant increase in the benefit. It falls away at the same time as the 25% tax rate kicks in. So I think it's a clear indication that we need to be planning ahead for that change. And then finally, I think the kind of one of the big losers is the beauty industry. It's been mentioned. There was a lot of expectation around whether or not there could be a reduced rate of 5% VAT for that particular industry. It's one of the industries that's been hardest hit as a result of COVID, but there was no announcement on that at all.
Okay, thanks very much, Phil. And just coming back to the capital gains tax area, which I think you both mentioned, I think we and many others have been very busy over the last 3 or 4 months talking to clients who have been keen to, who are going to sell their business. They were keen to sell by yesterday, just in case anything changed. Do we have a view on whether there's now another little window of time where that should happen? Is there any other indications so far that these rates might change, or is it just, as you say, it's quite generous now, so if you're going to do it anyway?
Shall I pick up on that one to start with? So if we go back to November last year, there was a report which came out from the Office of Tax Simplification on capital gains tax, which spurred a lot of excitement in December and January about doing planning. I think my own assessment is it's not going to get any better than it is at the moment. And there was talk then about the discrepancy between income tax rates and capital gains tax rates. And if I look back, income tax and capital gains tax rates were aligned between 1988 and 2008. And as T'other Alex was saying a little earlier, if you hang around long enough, what goes around comes around. Could we go back to that? And it's been suggested that actually what we should do is align them again, because then it won't, the boundary between income tax and capital gains rates will disappear. But if that happens, then there should be some measure of inflation brought in as a compensator. One of the recommendations was that if you look at the number of tax returns, and of course they can get this data from HMRC anyway, the number of tax returns that report net gains each year that are just below the annual exemption is something like 50,000. So actually having an annual exemption of what is now 12,300 can distort behaviours, and that was one of the things they wanted to do. So I suppose the good news from yesterday was that actually the annual exemption remains at 12,300. Okay, we know it's going to remain there for the next 5 years till 2026, but the good news is that he didn't reduce it. So I suppose that is some good news. They're talking about having more real-time capital gains tax reporting and payment of tax. So, for example, if you sell your second home now and you're a UK resident, then you have to report that within 30 days of completion and pay an estimate of the capital gains tax. That system seems to be working. We're certainly making some of those returns on behalf of clients. There's no reason why that shouldn't be extended to other assets as well. But it's not all bad news. They're also talking about broadening the chattels exemption and looking at some greater relief for making gifts to people without having to pay capital gains tax and extending the holdover election. However, they are also looking, together with the inheritance tax review that was done, about the capital gains tax exemption on death, because sometimes you can get both no inheritance tax on death and a capital gains tax free uplift to market value, so you wash out the gains. On other occasions, if you've given something away and then you die within 7 years, you get caught for both the capital gains tax and the IHT. Instead of being nothing or both, it should perhaps be one or the other. So that's really being looked at. They're talking about rebasing assets to 2000. So if you bought or acquired an asset a long time ago, then the market value is automatically rebased to March 1982. Well, for goodness sake, that's nearly 40 years ago. So we're finding practical difficulties. I could name a number of incidents where we've had to go back in 2020 to get land valued as it was at 1982, or a house valued as it was at 1982. Well, who knows what the condition, nobody thought I'll take pictures of the schedule of condition then. So that's important, I think. The other one I think that's also worth taking note of is they're looking at business asset disposal relief. What is it really there for? If it is there to reward long-time owners of businesses, then should they think back to perhaps some of the retirement relief criteria? Should there be an age limit reintroduced, which I think, if I remember back to retirement relief, was 55? Should you increase the holding time for shares from 2 years to 10, so that you really ought to be working in a business for a long time rather than just 2 years? And should the holding be increased to 25%, so that you genuinely reward business owners, but not just say 5% shareholders? So that's what's in the report, is the headline stuff. That still sits with the Chancellor. My own view is that wouldn't come in this budget, because he got other things to fry, and he'd gone fairly public about not increasing the tax take now until the pandemic was over, which I think he can probably just about argue he's done, because he's given us an increase in thresholds and rates broadly in line with CPI, apart from IHT. But it is stuff that's coming in down the line, and this stuff sits on the stock. So my arguments would be, I think we've got a relatively benign regime at the moment. There are opportunities there to plan, and it's probably worth taking advantage of those sooner rather than later if you wish to.
I think it's also worth highlighting that the expectation or the anticipation was always that the autumn budget would be the budget that would make some of the big announcements in time for the following tax year. So I think in terms of Alex, going back to your original question, I think there is a window now between now and that autumn budget, whereby if you are in the process of thinking about planning, thinking about disposals, now, like Ian says, is the opportunity is there, because the rates are probably never going to get better than they are currently.
Thank you. So, I mean, from what you both say, and looking at both capital gains tax and inheritance tax, it sounds like that some of the planning opportunities that previously existed do still exist, and now may well be a very good time to think about those.
Yeah, I think so. And we haven't touched on inheritance tax, but in terms of IHT planning, we have the PETS regime. So if you make a gift and you survive 7 years, that's fine. Okay, you might have a capital gain to manage in the meantime. And part of tax planning is about deciding which tax you want to pay and when. And so a lot of people will take a chance on paying, let's say, capital gains tax at 20% now, and either insure the gift they've made or do it when they have a life expectancy of 7 years. Because, of course, remember, at the moment, if you survive beyond 3 years and there is tax to pay, then taper relief kicks in and reduces the tax paid until you get to 7 years. And some of the recommendations from the inheritance tax report, which came out in July 2019, are to simplify the 7 year period, perhaps reduce it to 5, which would be good, but also on some of the business results, we have a slight anomaly in that for inheritance tax purposes, it's a 50% test if your business is wholly or mainly trading, or your asset is wholly mainly trading. That's fine. But for capital gains tax, it's an 80% test. And so the talk is of increasing that 50% threshold to an 80% threshold. So again, that hasn't seen the light of day. The Office for Tax Simplification report was more of a tinkering and refinement. There was then another report which came out in January of last year from the All-Party Parliamentary Group, which is a rather more fundamental rewrite, which gives you one lifetime allowance. Broadly, business and agricultural reliefs go, and you get an annual amount that you can gift of, and they were suggesting £30,000 annually. But the rate of IHT comes down to somewhere between 10 and 20%. The popular views are that it's the OTS that will have more traction than because they were asked to do it, rather than the All-Party Parliamentary Group, who I think just went off and did it off their own bat. but it just gives a flavour of what might come down the line.
Okay, thanks very much, Ian. Just changing the subject slightly. Alex, in his slides earlier, mentioned some sort of new help for businesses that have been affected by COVID, and I think a number of people have commented over the last, well, since the announcements last March of the initial packages of measures. A number of people have commented that they didn't allow people who recently become self-employed to claim. I think there's something new that has come in recently yesterday that now may allow those people to claim if they are self-employed. Are you able to sort of elaborate on that at all?
Yeah, I think it's as Alex said, if you didn't fall into the category of being able to claim because your business was too new, and I can think of one or two of those people, provided you filed your tax return by midnight on Sunday night, then you now may be able to claim for relief, and that, you know, that's welcome news. I guess it also penalises those people who, for whatever reason, might not have got their tax returns filed on time.
Okay, thanks, Ian. Phil, if I can sort of just think about companies more for a few minutes, and I think again Alex mentioned obviously in the headline being the corporate tax rate changing from the current rate up to 25% in April 2023. Perhaps you could just talk us through some of the detail of that and explain how that might work.
Yeah, sure. I think you're right. I think in advance of the budget, kind of the increase in corporation tax rates was something that was widely anticipated. I think what's fair to say is that no one probably expected it to be quite such a significant increase from the 19 to 25%. And for it to be an overnight increase without any sort of sliding scale that might be set out. It's interesting because they've obviously undone a large amount of the work that was done over the past 10 years to reduce corporation tax rates. And also we've moved from a position of having different rates for small companies and large companies to now where that got moved to being aligned, for that now to have been unwound again, introducing additional complexity. I think much was made about 25% still being competitive when you compare that to the G7. And I think from our perspective, when you look at our closer EU counterparts, it's hard to ignore that 25% is double the rate of Ireland. It's also a significant departure if we think about only a couple of years ago, the expectation that corporation tax rates would fall as much potentially as low as 17%. A rate that obviously never came through. And so whilst we've got a situation where we're expecting this increase to 25%, the fact that it's pushed out to April 23 does give the Chancellor some flexibility if the economy does recover better than expected. I think the key thing will be waiting to see whether or not this actually has, or increases the barrier to new foreign investment.
Okay, thank you, Phil. So if I'm a smaller company and there's a definition yesterday of a company making profits of 50,000, but then the sort of band between 50 and 250,000 being sort of a sliding scale. If I'm one of those companies, what do I need to consider? Do I need to think about anything over the next year or so?
Yeah, definitely. So it's an interesting one for smaller businesses because I think that whilst they kept this 50,000 and the 250,000 limit in for smaller businesses, it is significantly smaller than what was introduced or what were in the rules several years ago. Those limits previously for a small company were 300,000 and then 1.5 million. So it's quite a substantial kind of reduction. And the other thing that kind of changed that was in the detail is that the definition of associated companies has changed. And the reason that's important is that these limits are divided by the number of associated companies. Typically, that was within a group. So if you had two companies that formed a group, we were looking at much lower limits. And that's been extended so that it's now an associated company that can include two companies that are under the control of the same individual. Which means that I think there will be more companies than we expect that will actually get caught by these higher rates of tax. The other thing that businesses will need to think about is that marginal rate that Alex mentioned previously of the 26.5%, between the lower limit and the upper limit does shift the balance when considering things like dividends versus salary planning. So I think historically it's very much been a view that, you know, paying a low salary with the rest of it being distributed as dividends was always beneficial. I think now that will have shifted slightly, and whilst you need to look at the facts and circumstances and to seek advice because every situation is different, I think for those businesses that can anticipate being in that marginal rate, there may be a bigger advantage now to extracting some of that value through salary rather than as a dividend.
Okay, so potential obviously increases in corporate tax on that side, but on the more positive side, perhaps if you have made losses over the last few years, some changes to the loss making rules, which Ian alluded to earlier. So just could you remind us which periods that applies to, and perhaps we can then talk in a bit more detail about how that works.
Yeah, exactly. Yeah, so as been mentioned before, companies will have this temporary extension for loss carryback. It's for trading losses. It's an extension, moving it from the original 12 months to a 3-year period. And it applies to trading losses that have been incurred for accounting periods. So for companies, for their accounting period that ends after the 1st of April 2020 up to 31st of March 22.
Okay, so some of those accounting periods may have already ended, and we may have already prepared tax returns for those accounting periods. So can we now go back and amend those returns?
Yeah, I think that's a really good point. I think it's important that if you had for example, a June 20 year end, there will be a significant number of those businesses that will have submitted and completed that tax return, but they'll be within these rules. So I think it is important that those businesses that have a year end that ends after the 1st of April 20, where they have got losses, that they do go back and reassess what the options are. And I think it's important to kind of note that whilst the 12-month period is uncapped in terms of the loss carryback for the first 12 months, there is still the 2 million cap that's been mentioned for being able to carry back losses to those earlier periods. The advantage is obviously you get 2 stabs at that 2 million, depending on how the business is done over that period of time. But I think there are probably two key planning areas that you need to think about. One is around changing the year end. So there is an opportunity here to look at whether or not, if you do need to accelerate the access to this relief, being able to change the year end to bring that forward might give you an opportunity to be able to access or to be able to carry the losses back sooner, which could kind of help from a cash flow perspective. And the other one is obviously that it's a choice around whether or not you carry that loss back. The alternative is that the loss will be carried forward, and with the rates going up to potentially 25% in the future, there is obviously a kind of a balance to be struck between the cash flow advantage and the certainty of being able to carry the loss back against the ability to carry it forward and obtaining relief at higher rates in the future.
Okay, thanks. So definitely some points for discussion there over the next year or so. And then another area where potentially there are sort of opportunities for companies now, and an area to talk about, and it's certainly coming through on the questions already, is this what's been called a super deduction for capital expenditure to increase investment. And when I was listening to the budget yesterday, he talked about investment, and then he talked about plant and machinery. But what does he mean by that? How does it work?
Yeah, and there's a lot in the detail, and I think it's important that businesses do kind of get under the skin and understand the detail. So it was something that was really unexpected. None of us saw this as being something that would be introduced, but it is a welcome boost for those that are in a position to be able to invest in capital expenditure over the course of the next 2 years. And it's something that I think the Treasury are expecting to see a significant uptake on. It's been costed at around £12 billion over the course of the next 2 years. And it also does move us to being one of the most generous within the OECD when it comes to investment relief, which is obviously a really big positive sign. And I think the biggest winners are going to be the large companies. There's obviously quite an interaction between this super deduction and the annual investment allowance. So for those businesses that are spending in excess of the £1 million, it will represent a significant windfall, because you have the ability to get potentially up to nearly 25% for every pound that you spend, particularly in that kind of the larger spend over the £1 million. And I think for businesses whereby they're spending less than £1 million, it is still really beneficial. But because of the annual investment allowance, they were already expecting to get full relief for that expenditure. So it's the extra 30% relief, which after being tax affected is basically 6 pence for every pound of additional spend. And so I think putting that into context, if you've got someone that spent the full £1 million on the qualifying plant and machinery, it's the difference between tax relief of 190,000 or nearly 250,000. So it's a number that's beneficial, but the really big benefit comes through for those businesses that are spending more than £1 million. And I think one of the things that we shouldn't lose sight of is that the 50% first year allowance for other assets that don't qualify for that main pool, so things like lighting and heating, which would otherwise typically have benefited only from a 6% writing down allowance, and we'll see quite a significant advantage as well. So if you've got large fit out costs, for example, on buildings, where there would be a significant amount that might fall into that special rate pool, and that 50% first year allowance will make a big difference.
Okay, and in terms of what qualifies, are we talking about the same sorts of things as would qualify for the normal 100% writing down allowance? So things like computer equipment, for example.
Yeah, exactly. So it's everything that we would typically expect for plant and machinery into your main pool. So computer equipment, and all of the different kind of fixtures and fittings and furnishings and things that would typically come within that. There are some kind of key exceptions, and one is cars, in the sense that cars are something that are excluded, and the other one is second-hand equipment. So it's important that it is new. The other kind of thing that's in the detail that comes through is that it will become a significant burden for businesses, because you will need to track all of your expenditure really closely, because when you dispose of an asset that has qualified for this super deduction, rather than bringing in the disposal proceeds just like you would normally, you'll now need to bring in 1.3 times that disposal proceed into the calculation at the end. And obviously that won't be relevant if you're scrapping things, but if you've got disposals where you're disposing of it for value, you'll need to now track that through. So it does become an additional burden for businesses to make sure that they can separate that out.
Okay, and then just finally, Phil, before we sort of move on, I think many of our clients and many people know people who are major beneficiaries of the R&D tax credit scheme incentives that have been around for a while now. I understand that there's a consultation that will look at that in a bit more, well, it's just going to review how that works. Can you explain a bit more about that and what that might mean?
Yeah, I think it's important to put into context that R&D has been an area that, every budget we see changes come through. So it's interesting that this budget was relatively silent on R&D. There was a very recent R&D consultation that we shouldn't forget about, which was very much focused at avoidance within the area of R&D. And you can see that being a key driver for them going forward, which is making sure that it isn't used for tax evasion and it is genuine businesses that should be benefiting from it. But the new consultation that's been announced is very much aimed at making sure that it is a fit for purpose incentive that does drive the right behaviours. We currently have 2 different rates for SMEs and then a scheme for larger businesses. Within the consultation is discussion around whether or not they should be combined, but potentially with different different reliefs for different size of businesses, and potentially even different reliefs for different industries. So it is something that is quite far-reaching in terms of the amount that's covered within that. and it's trying to look at how best they incentivize businesses. Should it be around green technologies? How does it compare to other countries? But it's very much a consultation at this stage, and we'll need to wait and see what the output of that is in due course.
Super, thank you very much. I just want to bring Alex and Mira into the discussion now. I think one of the things that's been talked about for a while, and people have talked about the phrase free ports for the last few years, and I think it was in the Conservative manifesto for the 2019 election. Many of us will have heard the word but don't really know what they are. But one of the locations announced yesterday was Solent, which isn't too far away from most of our locations as a firm, and obviously we have an office in Southampton where Alex is based. So Alex, would you be able to just give us a brief overview of what is a free port?
Yes, sure. Well, I mean, basically, it's just a special economic zone, really, that benefits from different tax rates and to make business easier and cheaper. So I think it really was very good news for the Solent region, the announcement yesterday, and it covers not only the Port of Southampton but also Portsmouth. I think it covers various areas of the Isle of Wight, Marchwood and things, so it's quite extensive, and possibly also some areas around the airport, and indeed Freeport zones can somehow link to sites that are up to 28 miles away, as I understand it. But I mean, I think the headlines that have been announced is that they think that this may well create around 52,000 extra jobs in the region, more than half of those actually in the Solent area itself. And around sort of 2 billion of investment, and particularly sort of supporting obviously the maritime industry, but also science and research, logistics, defence, are all things that have been mentioned, and with a focus on green ambitions as well. But I don't really have any of the detail on that. So just to sum up really what the tax benefits are, if you like, that I've alluded to, is that it applies for a 5-year period. And one of the key ones really is valuable customs duties and VAT relaxations are introduced. But then there's also, if you're buying or building new buildings, you can effectively write off the cost of those buildings for tax purposes over 10 years instead of the normal 33 years. So that's pretty welcome. Phil's obviously just talked quite a lot about capital allowances. But the point is here as well, within the sort of Freeport area, you'll be able to get 100% plant and machinery allowances, and that's through until September 26 because of the 5-year sort of period. So it goes beyond these current sort of relaxations that Phil's just been discussing. Full stamp duty land tax relief on buying properties. Again, the non-residential rates are sort of 5% typically on SDLT, so that's valuable. Full business rate relief, as I understand it, and that's for new businesses and those that are sort of significantly expanding. And the other thing I saw, but it's going to be subject to parliamentary approval, is that there's going to be a proposed relief for employers' national insurance, which is charged at 13.8% on wages. So a whole package of measures really within that looks really exciting for the Solent region.
Sounds great, that does. And so Mira, can you tell us a bit more about the benefits in terms of customs duties and VAT?
Yes, thanks, Alex. Good morning, all. Yes, the free port is very similar to, is the same as providing within the existing customs bonded warehouse approved by HMRC. What is the good thing about this free port is that, for example, you're going to bring in 100,000 sports gear, say, into the country, but where you don't have the customers for, you can leave that in your free port without paying any customs duty or VAT. You don't have to clear those goods. You can just leave them there until you find the customers. Say for out of those 100,000 goods, say you get an order for 10,000, only at that point you would pay the customs duty and import VAT to clear the goods. Again, with the import VAT, you don't have to pay it. Now we've got something called the postponed accounting. It's like an in and out entry in your VAT return. So you don't have to pay the physically pay that money over to HMRC. So all of these measures is going to help the businesses in terms of cash flow. The other major benefit is there's no administration burden when it comes to customs warehouse or bonded warehouse, where currently you're leaving your goods in someone else's warehouse, and you need to pay administration fee for them to monitor the goods. And if you want like 10 goods out of there, then you need to go and give them a receipt to say, can you move these goods? Where in Freeport, you're in control of your goods. So it makes it much more easier for you, all businesses, to deal with your own goods in Freeport. And also you can avoid, where people have applying temporary admission relief at imports such as inward processing, you don't have to do that. So you can leave those goods in Freeport until such time you need to clear the goods. And the other good thing is in Freeport, you can leave those goods, and if you find customers in France, Germany, Italy, and it can go out of that Freeport straight to those countries. And at that point in that country is where you would pay the customs duty and VAT, so you don't have to clear it in the UK. So all in all, I think a lot of businesses will benefit from it. I think in pre-Brexit, there's a lot of anxiousness about, where they're going to get the money from businesses, how they're going to pay the duty and VAT. And I think this is a really good system for those people. And I think a lot of business are going to benefit. Happy to take any follow-on questions from it later, but, we can help you with that. And it is not complex. It is straightforward. It's easy to monitor.
Okay, thanks, Mira. So if you do have any further questions, do obviously put them into the Q&A box, but equally do get in touch with Mira and her team on that. Certainly agree with Alex and Mira that I think it's going to be very beneficial to businesses located in the Solent area. Mira, while you're on, just turning to VAT and sort of more standard VAT type questions, I guess. Obviously, we've had the reduced rate for VAT for hospitality over the last, nearly a year now. How will the extension of this reduced rate affect relevant businesses, and what are the pitfalls that they should look out for?
Sure. It's definitely going to help businesses for the next 6 months, and then a further 6 months at 5% first and then 12.5%. It is going to, this includes like hotels, holiday accommodations, pubs, cafes, restaurants, and admission to attractions like theatres and cinemas and amusement parks. Well, the good thing is the businesses don't have to pass on the tax break to customers, which means that allows them to, if you want to win the customers over, they can reduce the price if they want, they can give a discount, all of these things they're able to do because it will benefit the business. That is one benefit to the businesses. But what I would like to remind people is, this 5% rate includes, when it comes to food and restaurants, it also includes takeaways. What it doesn't include is alcoholic drinks. So when you are doing the bills, you really have to be careful. Businesses have to be very careful. You separate the bills. If I can give you an example, if you're going into a restaurant or a pub and you're going to have some food and a bottle of wine and some beer and some juices, you will only get the 5% on juice and the food, and it'll be standard rate for the alcohol you're going to consume. So it is if you are in these businesses, be very careful how you do the billing. So basically, you don't want to overpay VAT, at the same time you don't want to underpay it either. And it works the same way when you are in a recovery position. If you're going to recover VAT on any of these, you just have to make sure you go through your bill to make sure that you're not reclaiming more than what you should do, what you've been charged. Especially for hotel industry, they really do have to. You can stay in a hotel, and if you're going to get one bill for your stay and your food and your drinks and everything else, and you really do have to think about how you're going to look at this look at the billing and how you're going to apply these rates. We're already seeing errors, and there's a lot of clients that we have helped. It is a very simple mistake to make. And also in your software system, look out for all of those. You need to how you're going to make these changes from a 20% to 5%, then to 12.5%. It might be an idea where you can put some reminders to say that, you know, I need to change the rate now. So let's look at it, how we're going to do it and how we're going to do the billing system. And it is very important that you do look at it. And, you know, this reduction, 5% and 12.5% reduction, does not override the existing no VAT rule for not-for-profit bodies who provide admission to cultural events. So that's no change to that. The main pitfall is that where people aren't adjusting their billing is where it's been an issue. And I would really, really encourage people to look at your billing very carefully.
Okay, thank you very much, Mira. Time is going on, and just I should have said at the start, we are aiming to finish by 11:30. So I think what we'll do now is move to sort of more general open questions. So they are coming through. So if you do have questions, please do add them. We're also just going to put up the next poll question now while Ian, Phil and Alex find their video cameras to turn themselves back on. That new poll question should appear, and then as I mentioned, we're just going to have some time now for some general questions before we finish. So they have been coming in, as I said, and firstly, I think this is probably going to be one for you, Phil. We're back to the super deduction, and two specific queries on this. Firstly, is there a limit, and what about the old favourite electric cars? Can they benefit from that?
Yeah, no worries. And obviously Alex will feel free to chip in as well. So my understanding is there's no limit. So there's definitely nothing that's been set in there. Which is where those larger claims will benefit. But electric cars will be excluded. They're part of a separate regime, and therefore they'll continue to benefit under, you know, their own first year allowances, but won't get the uplift.
Okay, thanks, Phil. So hopefully that answers that question. I think Mira, I think this might be one for you. In the presentation, we've heard about restart grants for a number of sectors that have been particularly hit, but there was also mention of support for the arts and something that we do a lot of in terms of film production. Are you able to sort of tell us any more about that?
Yeah. I think Chancellor yesterday specifically mentioned film and TV production restart scheme. The government is making available 700 million to support the art and cultural and sporting institution as they reopen, which includes an extension to the 500 million film and TV production restart scheme. The objective of this scheme is therefore to support the film and television industry. We know a lot of the films half done and they've not finished it, or they had a release date and they're unable to release it because the cinemas are closed. And also when where the films and TV productions been in post-production stage, they're unable to complete because of the COVID situation. So to help those films and TV production, you know, you can apply for this restart scheme. What I would advise people is to go into the government website for film and TV production restart scheme. And if you follow that through, it looks fairly simple, but we are here to help if you ever get stuck with it.
Thanks, Mira. And then turning back to inheritance tax, a fairly specific question, Ian, probably one for you on this. The question is, if I make a gift of £25,000 within 7 years of death, will IHT be payable? And I guess the answer might be it depends to a certain extent, but did you want to comment on that?
Thanks, Alex. You're absolutely right. It depends because so you have your nil rate band available. I'm just going to ignore the residential nil rate band for the time being. We've got your nil rate band available of 325,000. It's been that limit since about 2009, so it's been there for a long time. So the first £325,000 worth of gifts you make in your lifetime merely start using up that band. So you've got that band intact. If you make a gift today of £25,000 and you died tomorrow, then all that you've got left is £300,000 of your nil rate band. If you've already used up your nil rate band because you've made other gifts to individuals or a transfer to trusts, and you make a gift of £25,000 today and you died tomorrow, then the £25,000 gift today will be taxed at 40% tomorrow. So you've got a £10,000 tax bill, which is then paid by the person who has received the gift. So in those cases, you know, if you know you're going to, you've already used up your nil rate band, then the donee usually thinks about, can they insure the donor? And again, I mentioned taper relief, so that once you get past the 3rd anniversary of making the gift, then broadly 20% of the tax that will be payable, not the gift, 20% of the tax that will be payable on that gift drops off each year that you survive till you get to 7 years and it's all dropped off the clock.
Okay, thanks very much, Ian. Another question's come through. It's not specifically tax related, but I can probably quickly comment. Was there mention of extension of the moratorium on commercial landlords seeking possession from commercial tenants? And I think that had been announced back in February that would go up to the end of June. And as far as we know, that wasn't specifically referred to in the budget yesterday. So I think the answer to that one is no. Again, just looking at the questions coming through, I've probably got time for one more. Alex, if I come to you on this one, I think for many years, Conservative governments particularly have articulated the policy that lower taxes result in increased revenues for HMRC. Given everything that's happened, are we saying that that's no longer true?
I think it's fair to say they perhaps do seem to have abandoned that. I mean, I think the headline was that the tax burden is going to increase to 35% of GDP, which was something that was last seen in the 1960s. I think it basically, as I see it anyway, I think it comes down to the fact that they don't think they've got a choice. You know, got to deal with the deficit, and therefore this is a way to do it. I mean, I said during my talk that, you know, a lot of it seems to be about the hope that the economy will do better. And I do wonder that, you know, if the economy does really well, whether actually he might roll back from some of these tax increases that are being announced. Who knows? We wait to see. And I think the other sort of thing just to mention really is that, of course, it's not that long ago that corporation tax rates were in the sort of 30 or even the low 30%, and that really actually these current low rates that we've got, you know, we're really in a response to the banking crisis and the recession back in 2008-9 really. So actually, you know, 25% is still relatively competitive compared to rates of old, and as the Chancellor was at pains to point out, is also still the most competitive rate in the G7.
Okay, thanks, Alex. I've probably got time just for one more question, but before we do that, I'm just going to put up the last poll question for everybody to answer. Slightly different one, this one. Hopefully you get the meaning of it. Within government, where do you think Rishi is best placed then? So either number 11 Downing Street or number 10 Downing Street. So if you answer that one, and then just one final question, and I think I'm not sure whether Alex or Phil want to answer this. Following obviously the UK leaving the EU, were there any announcements about new Innovate grants for SMEs yesterday? Phil, I don't know if you wanted to take that, or Alex.
I'll let Alex take that one.
Well, I think I was going to say I didn't see any specific sort of announcements. I mean, there were a whole raft of announcements about sort of supporting, you know, green technologies and all sorts of things, weren't there? But I didn't see anything sort of specific that certainly that I can comment on today anyway.
Okay, thank you very much, everybody. Thanks, Alex, for that. Thanks, Mira, Ian, and Phil for your comments. So thank you to you then as well for listening. I haven't been able to see anybody, which has been a very strange experience. I can only see the other four panelists in front of me on my screens. But thank you for listening. I know you've been there through the many questions that have been coming through and the voting that's been going on. I hope you've found the session today useful. It's been a bit different in many ways. The last year has obviously been very different in many ways. As ever, though, with tax and business-related matters, personal related matters, the devil is in the detail, and much of what gets announced, much of the rules, it doesn't necessarily come out on the day, and so we do often, we always need to consider the particular circumstances of the individual or the business to properly advise them. So I think if you do have any comments or concerns, or you're thinking about your own situation, it is really important to consult with your advisor, consult with the person you normally speak to at James Cooper Creston to talk about your particular circumstances, because everybody will be slightly different. Okay, so I think the polls have hopefully now closed, and we can have a little look at the results of those. I'm just waiting for that to happen. So the first question was about in his second budget, did you think that Rishi did a good job? And I'm just waiting for the answers to come up to those. Hopefully that'll appear on my screen in a minute, because I'm not seeing anything at the moment. It doesn't seem to be coming up on my screen, so perhaps we'll have to let everybody know the answers to the polls in due course in the mailings that come out after this. So I think we're going to wrap up there. Thank you very much to all of the panelists, as I mentioned earlier, but also many thanks to all the people in the background who've made this happen, to Lizzie, to Andy from James Cooper Creston, and also to SFL, who are the whizzes in the background who managed to make my Microsoft Teams pop up on your screen and everybody appear in the right place. As I mentioned, there will be other information that will come out after this, but do get in touch with your usual contact, or indeed one of the people who've been presenting today, if you would like to discuss more, particularly where you've asked a question. Apologies, we've not had time to answer those. But as I said, do get in touch with us. And all I want to say then is I hope to see many of you soon, even though I've not been able to see you today, either on Zoom or Teams or even in real life. And in the meantime, please do stay safe and have a good day. Thank you very much for listening.